Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter like we normally do. I'll share my opinions as we go through it, see what people are talking about. It's generally related to three topics: wealth building, finances, and commodities. I think I'll cover a wide array in this one between the three, and I'll sprinkle in my financial opinion and my experiences that I've had investing, going through life, whatever it may be in my wealth building journey, is what I'll call it. And I'll share basically freely whatever I think. So let's go in. Let's see what people are talking about. If you want to follow me at finding_finance, and if you want to join our community, love to have you a part of the community. Finding-value.com. If you don't think it's right for you, or if you think it might be okay, just send me an email and ask. I'm pretty understanding if you want to try it out and things don't work out, just message me and I'll tell you what I offer and all that stuff if you are interested at all. And we do have a discount going on, LEAP, LEAP. It is leap year, so LEAP is the coupon code. So Fire Guy. Now, I've talked about this maybe a couple times before. I'm going to hit this again. I don't know if people are, because a lot of the people have all of the same answer, and I'm going to give you something that may be different than what they say. So, which is most impactful? Increasing your income, new job, raises, promotions, side hustles, etc., or reducing expenses, which is budgeting, cutting back, paying off debt, couponing, etc. It's 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 the same coin but different sides, guys. You want to maximize the difference between your income and your expenses. So it's great. Most people will say, oh, it's obviously most impactful to increase your income. And it's like, okay, so why don't you make like $500 million a year then? Oh, well, exactly, because it's not easy to increase your income. If I said in the next month, I want you to save $500 more, how would you do it? Are you going to go get a new side hustle? Are you going to ask for a promotion or a raise? What if you just got promoted? The easiest thing you can do is reduce your expenses. That would be the easiest thing for that particular month to increase $500 or do something to cover an, an, an expense that was not expected. The difference, and I'll just tell you this, it's not necessarily about income and it's not necessarily about expenses. It's about being happy with less. It's being happy with less. And I'm not saying that you have to be a minimalist to be happy or anything like that, but if you are seeking happiness because you have to go on this expensive vacation, are you seeking happiness through buying this item or this thing that you must have and you get caught up in the race of status, you get caught up in the race of trying to compete and compare yourself to others? I think that's where the difference is between me and a lot of other individuals. People want to make money to go buy that cool thing. And for me, I just don't care. I don't know if it's just not in me, if it's genetics, if it was how I grew up. I think there's a strong component of genetics and personality, and then a strong component of what I care about in life. So, yes, increasing your income is fantastic, and everyone should do that. And yes, reducing expenses is also something that everyone should try to strive to do to maximize the difference. But if you're not happy, money's not going to make you happy. And the things that I get impressed by, me personally, has nothing to do with what you own. It has everything to do with the skills that someone acquires, the strength and effort that they put into getting it, the skill of some sort of artwork, something that can't be replicated. Being a doctor, in my opinion, it's not that impressive. It's impressive that they went through it and they accomplished something, yes. But a lot of people can be a doctor. a lot of people can do a lot of different things if they want to put their mind to it. So to me, I don't really get impressed all that much unless I see something that is worthy of being impressed by. So here's Christine. She says, here comes some rigs. Count needs to climb further simply for all these Permian companies to hold their oil rates flat. And that deals with the Dukes, the drilled uncompleted wells that are basically depleted. So the rig count was up in oil by +6, and gas was down by 1. So we were net positive 5 rig count. So a lot of people think that we're just going to go forward and oil is just going to continue to keep pumping into the world. I think that we take oil for granted. And at some point, I think we are going to get pretty tight on oil in the next few years. I said few there, 2 or 3 years. And the appreciation of oil is going to rapidly increase. And I think the price is going to go way up. I think the most undervalued asset in this world is not silver, but it is actually oil. It's the most underappreciated asset. It is the number one commodity. We have grown our population because of oil and natural gas, I'll say, to some extent. You've got fertilizers and all this stuff. And I'm not convinced that we can have a life without it. So I think oil being the number one commodity, it's the most inflation sensitive. If they hit the printing press because of whatever reason, debt, they want to do something with the debt, it's always increasing the money supply. Your protection against that is obviously gold and silver, but it's also oil because it's so inflation sensitive. It's also something that depletes and is not replaceable. It goes away as you use it. So that's something that I think there. Quitting your job with only 6 months worth of expenses is a sure way to end up in the same bad situation. Yeah, and I want to. Yeah, 6 months is not. It's not resilient enough. And if you have investments, that makes you more resilient because you can tap into investments. You can tap into your savings, your precious metals, or whatever you own. You can sell cars if you have cars, but 6 months is not that much of savings. You really gotta find a job pretty quick, and you're probably going to be pretty desperate to get a job within the first few months because you don't want to deplete your savings down to nothing. So I think being more resilient than 6 months is definitely my goal, at least, and I'm way past 6 months. But I think for everyone, if you're trying to save, the whole goal is to increase purchasing power, and in my opinion, it's to become more resilient in life. If things get thrown at you, you just shrug it off. Oh, my kid has a $2,000 hospital bill. That's no big deal. Oh, my car broke down. My heating unit went out, and my kid went to the hospital all in the same month. I've got a $10,000 or $20,000 bill. No big deal. That's resiliency. It's being able to not really sweat anything. Um, so that's the way that I look at it, and I want to do that with basically um, my entire life with going through. It's like, there's a bill, no big deal. I got the cash flow to cover it. So that's the life that I'm trying to build, and I don't even think about 6 months worth of expenses anymore. I just think of how can I increase my cash flow in relationship to my expenses? How do I really have a gigantic buffer in my cash flow? And when I think of cash flow, and I do this with the investments, I snowball it, I do all those things. What does that look like? What does it feel like? Why am I doing it? What's the whole point of this thing? The whole point of investing is to increase the purchasing power or to reduce stress, or in my opinion, it's to build resiliency. So what I could do is I could say, well, I'm always going to have a 10 grand per month spare amount where I can float something. So if I have 10 grand extra cash flow a month where I get it from somewhere, dividends, working, whatever it is, you can basically weather anything. So what I'm trying to do is build the cash flow first, and then your expenses can drift higher with your cash flow. And if you want to go on those expensive trips and do whatever you want, just increase the cash flow, which it doesn't mean you have to go get a different job. It doesn't mean that you have to go do something different. It just means that maybe you have to put your wealth in investments that pay you over time, and then you start building it. That's the way that I look at it. And yes, doing taxes is a total pain in the butt uh, for all of this income that you start to generate. You're going to start focusing more on how do you keep that money instead of just giving it all to the government. So that's what I think everyone's really trying to do is when you build resiliency, you have options, you have freedom, you have the things that you want to do in life that you don't want to, that you want to avoid. If there's things in your life that you want to avoid, you can do that. That is what the ultimate resiliency is in your life. So we've got Karen has a 1 million net worth of index funds, and Felicia receives $5,000 a month in cash flow from high income skills and ETFs. Which one you rocking with and why? I would go with whoever treats me better. I mean, that's who I would go with. I've got friends that are wealthy, and I've got friends that are not wealthy, and I go and hang out with people that respect me and that have similar interests. I really don't care about the money. And if I'm the one, if I already have my life set, I don't really care what other people make or have. It doesn't matter to me. That's that resiliency. It just doesn't matter. Now, if I'm trying to date one of these people, I don't. I would just go with whoever treats me the best and is the best looking is what I would choose. Um, I don't really care about the money aspect of it because if you got your stuff together, it doesn't matter what the other person brings to the table in terms of money, as long as they don't have debt. I would say it's pretty much good with me. Um, Today I'm at peak discouragement with energy prices, not the fundamentals. Oil fails at resistance again, minus 2%, no fundy news. Natural gas is minus 5% back near lows on, I think, no news. Overnight weather updates were fine. And uranium stocks are minus 2% to new lows, no news, no bear case. What I'm going to say is, guys, you're trying to explain the daily price movements. Daily price movements can swing from just sentiment or news, but news doesn't drive the stock price on the long term. I think it's almost got this backwards. The price moves, and then news is made up some of the time of why that price actually moved. So in the short term, there you can't apply logic to short-term price movements. It doesn't work. And all you can really do in the market is to buy undervalued assets. You can't necessarily control where the price is going to go, and you can't attribute why. And once you get over all of the stuff that you can't control, then you're going to have to ask yourself, what can I control? Well, you can control what stock to buy and when. And if something's cheap, that's your opportunity. You can't force something to be cheap. You can't force something higher. You can't do anything by forcing it or convincing it or influencing it in any sort of way. So I don't know why people worry about the short-term price movements. Um, you're going to have to look beyond that. Coming down, Jeff, I can't say his last name. It says one of the better strategies from 1963 to 2023 was simply avoiding companies who issue stock. They are on the right-hand side of the table, primarily in red. Stock repurchasers are on the left of the table, primarily in green. So I know we've got a lot of uranium investors, and I like uranium too, but here's one thing that I think um, messes with some of the uranium logic, I'll say. So what they'll say is there's a shortage of uranium. And what I'll say is you are correct, and I agree with your assessment. And I think that the price, physical price of uranium will go up. But the problem is, what I say to them is these companies are not that great of companies. The companies themselves, you're speculating, you're not investing. And I don't know if people understand what the difference is. Speculating is you're hoping that the price goes up of the underlying commodity, and then you're hoping that money finds the stock that you're in. That money rotates and you get more buyers to come and buy your stock. And a lot of people's, I'll say their logic is, well, we can't shut down uranium. It's 10% of the world's electricity power source. And it's like, okay, yeah, that's true. But I'm like, how is the company going to make money from the situation? And none of them, most of them can't. They don't make money from the situation. They are isolated from the commodity price move and the money making it to your account. So what I would say is I prefer certain sectors, I prefer certain companies, and the companies and the way that they're set up, the ease of that sector, where they're positioned in society in terms of needs, is where my money goes. And if uranium had a couple of baller companies, I'd be in them. And I would be invested in those baller companies. But a lot of them, I can't enter with any sort of size where I'm comfortable because of this problem right here. The highest quantile share issuance, where they issue shares and dilute you, are shown to underperform the market. And yes, I understand there's going to be a time in the sun where money comes rushing into uranium, and we are hoping that it goes up a lot. But there's also a lot of companies that are in the stock repurchaser group where this group competes with this group for my money. So if you have two groups that are competing for money, why would I not buy the stock repurchasers if they are currently undervalued? They are known to outperform, and they are telling me that they're about to buy back 100% of their free cash flow in share repurchases over the next year or two. Other companies, they have plans to pay down debt. After that debt is paid down, they are going to dramatically increase their stock purchases in a year. And then I look at this quartile, and some of these companies have nothing in sight till the 2030s, maybe, and they're going to dilute you from here to there. So when I look at this, I'm like, why the heck would I put any money in these when I can live in this group over here and outperform this group over here? Now, some people will say, well, it's the added risk, the potential return. I don't think that's the case, guys. There's sectors out there that are in this group of stock repurchasers that I think will run laps around this group over here because they're in a great sector with a bunch of leverage that are undervalued, that will buy back shares, reduce the share count, drive earnings per share higher, and absolutely rip it. There are some companies that did some pretty big stock repurchases, and in a few years, they've gone up over 100 times. So stock buybacks are massive when you're in a small cap growth company that is going to buy back the majority of its shares. It is ridiculous what that looks like in terms of a stock chart. You can get very, very, very big returns. And if they can grow production over the same time frame, maybe they can double their production in a few years. And they're buying back stock. That's ridiculous, guys. And the commodity price goes up too. That's the best situation that you can be in. It's also the least risky because generally this quartile eats it during a downturn, while this one's very resilient because you've got the stock buybacks that they're doing. That is a buyer basically holding that stock up underneath it. So anyway, the annualized returns were the greatest for stock repurchasers versus any other area. Coming down, we've got natural gas. The short interest in natural gas apparently just hit a new all-time high. And whenever this does unwind, this is where natural gas gets its volatility. If you've got a lot of shorts in it, it could unwind very quickly and get a big blast to the upside. What's your number one financial goal in 6 words or less? Mine is ultimate resiliency. And one thing I want to talk about here, I know there's some people that are talking about, it deals with the next one here. It says, I don't know who needs to hear this, but I don't regret paying off our 2.6% mortgage. And a lot of the people, they talk about paying off their mortgage as quickly as possible. Here's what I don't like about it. It leaves you vulnerable for a very long period of time. So if you continue to pay down your debt in your house, which is, I mean, I can understand it from a psychology standpoint. You don't want debt. You want to get out of debt. I agree with all of that. But your resiliency isn't as resilient if your focus was on to increase cash flow. So you've got this 2.6% mortgage. It's locked in for, let's just say 30 years. Okay. And you've got, I'll just make it up, a $300,000 mortgage. Make it up. So let's say in order to pay it off faster, that you're going to have to divert a lot more money into paying off the mortgage faster. The thing that leaves you vulnerable is you've got all your money tied up in your house. And what if you have a 6-month emergency fund? So if something occurs, you can last 6 months. And you put your house at risk of a problem then. You've got all your money tied up in your house. So you put all your money into your house, you have 6 months, if you lose your job or some income is lost, and you got a ticking time bomb on your hands of 6 months before you could potentially have a problem with your house. And all your money is tied up in your house. The way that I look at it, and I know I'm different than other people, and I'm not saying don't pay down your balance, but when I think of resiliency, I still own a mortgage. My mortgage is very low. I've got a lot of time left on it, and the payment is ultra low. And the reason I did that is because I think it increases my resiliency in any type of scenario. I can pay my mortgage off and be free and clear this second. But what if I put that money towards some of these stocks that I'm in that pay me 17% dividend yields or 10% dividend yields with a bunch of upside potential? Well, that's all more than 2.6%. And some of the dividend yields, when you hit hard times, can get cut back or they can be eliminated altogether. That is definitely a possibility. And some of the natural gas companies eliminated their dividend yield completely that I'm in. But that's also why I hold a variety of companies that pay me dividends in a bunch of different sectors. So I'm getting all these dividends that are resilient because if I lose any sort of single dividend payment, I'm not screwed. I've got a basket of groups from different sectors of different companies of different sizes, all paying me to hold their stock as they should, either in stock buybacks or dividends. Resiliency is having, if I have to pay the mortgage off sooner, that means that I could put $100,000 or $200,000 somewhere else over time. If I start to snowball the dividends of that, that means that I become more resilient. Because if I have dividends of, let's just say I save enough and I put $100,000 in dividends, and the dividend that I'm receiving on average is 10%. So that means if I have 100 grand, I earn $10,000 a year in dividends. Now, let's say I save more money than that, which I do, and that's just the difference in paying the mortgage off faster. So I save even more money. I get a larger dividend. Let's say it is not 10,000 a year, but 20,000 a year. That 20,000 a year covers my mortgage and maybe even a little bit of my living expenses, or maybe it's the property taxes or the insurance on the house. What are you going to do if you've got all your money tied up in your house, you lose your job, and you have only 6 months of savings? Let's say during that 6 months, you have to pay your home insurance, you have to pay your car insurance, you have to pay registration on your car and all these different things. You're going to eat through that safety. That's not being more resilient. Now, if you have that mortgage there, you've got the dividends starting to roll in, and that money that you would have put into the house, you put in to dividend stocks, and now you're generating $20,000 of income, and you still have your 6 months of emergency fund. I see that as more resilient, even though you're carrying some debt on your house. And that's the way that I view it. I view that life is like playing a game, and you want to be as resilient as possible. So I build resiliency with, holding physical metals, with getting dividend companies, with doing this YouTube channel, with all this other stuff. I become more resilient because if I lose any portion of my income, it's going to be a small amount and it won't impact me as much. And the resiliency to cover costs, I can cover them longer and play the game longer if I have to. I can dip into my investments, the $200,000 that I save that's paying me dividends. I can dip into that if I had to. I can dip into my 6 month of savings. I've got a health savings account where that's generating dividend payments, where I can take money out of it and cover my expenses tax free with tax free money that went into it. And then you keep building and building and building. And that is how I view resiliency of life. I can play the game longer. Now, I'm not saying that this strategy is necessarily for everyone, but that's how I view it. And my brother, he's paying down his mortgage as fast as he can. He wants to pay it off before he retires. And for me, I'm gonna I'm kind of already doing my own thing, and I don't really need to do it. And I did mine a completely different way. I put my money in dividend investments, and I'm trying to really ramp that to increase the difference between cash flow and expenses. That's how I'm doing it. Every wealthy person I know either owns a business, owns stocks, owns real estate, has a combination of these assets. None of them got rich because they had a nice watch or a sports car. It's just an observation. There's a lot of things that you can do in your life where you can have this stuff if you do it through a value perspective. So, I bought a car that wasn't running 100%. I bought it for $1,200. It was an RX-8. I put a new engine into it, and I put some modifications on it as I did all of that. And I hate to say it, I love the freaking car to death. And at the track, the thing is absolutely lethal. I re-drilled the front sway bar. I did all these things, okay? And I've got really good tires on it. I've really focused on balancing the car in terms of brake pad selection. I want it to be easily module so I can like modulate the brake. It sits, so you need to get the right balance between the front and rear brakes. I had to run more aggressive rear brake pads than the front to get the car to sit really nice for for autocross. So you can basically, it feels like you're glued to the road when you hit the brake, like it sucks you down. It's set up really, really well. And that car can beat very fast cars. And it is so rewarding to drive it to the limit and beat a Porsche GT4 with a very good driver behind it. Like it is so rewarding. And yeah, it's on a small track. It's not a really big track with big, big long straightaways or anything like that. It deals with car position, with car placement, car position, how fast you can kind of shift and take the corners and all that stuff. So you don't have to be wealthy. You don't have to do that. You can live life with a lot more value in it. And that's where I came up with the name Finding Value. I love finding value in things that people are throwing away that are perfectly fine, that have many, many years left in it, and you might just have to put a little bit of work into it. So that's the value that I find in the marketplace. What happens here? This is URNJ. Yeah, big selling pressure here, guys. We've got selling pressure in, this is Global X Uranium ETF. I think that's URA if I can remember. URNM, Sprott Uranium Miners ETF, URNM. So yeah, we're getting a little bit of a pullback here, guys. And this is the Sprott Physical Uranium Trust. It is selling off. We very well could go down a lot further and have a really big pullback. Does this change anything fundamentally in the sector? It does not. It does not. It's the same sector, just with different sentiment. People could perhaps be scared selling out. And we did suck in a lot of retail investors too, probably at the top here. Here's a stat for you. It says it's been 309 trading days since ChatGPT was released, 11/30/22, and the NASDAQ is up 46%. In 309 trading days after Netscape, the first web server or web browser, was released in December of 94, the NASDAQ was up about 46%. It doesn't get much closer than that, and maybe there is more left in the bubble of a lot of these AI stocks or in technology. And I'm just not there, guys. It's the value, the risk reward. It's not there. And when it's not there, that is when trouble can arise. I can tell you this. I am hearing a lot of people buying Nvidia, buying a lot of AI, and buying the technology companies. That scares the crap out of me. That makes me think that we are very close to a top. The more I see it in retail investors, the worse it gets. So, yeah. This is a sobering thought. All of the windmills currently installed will need to be replaced before our net zero target date of 2050. All of them. Welcome to the Red Queen effect. So as you go up, these things will age, they'll lose their efficiency, and eventually they'll need to be replaced. And by 2050, everything that is currently in out in the field and producing is going to have to be all replaced by 2050. So good luck with this. We've got Oxy. If buyers gain momentum above the 200 SMA next week, watch out. And I agree, we're going to go up. This looks fantastic for a big move. A broken pattern to the upside with good volume, and then we're gonna rip it. And I would say that that's probably going to be the case across the entire board of oil and potentially natural gas companies. They're all in the same ETFs. When money comes rotating over, that's generally when everything goes up. We've got Calvin here. He says, inflation down, sell commodities, recession, buy tech stocks. When inflation goes up, let's keep pumping tech stocks and pushing down commodities. He's probably also looking at the day-to-day movements. Patience, guys, patience. Ride it on up when it comes. Freight futures, AM update, dry bulk is up 7%, Panamax up 2%. That's why we're seeing the dry bulk companies really go up. Lots of value there. And then tankers, VLCC was down 1%. Not a big deal. And this is it. Looking at a chart, this is the Cape size futures, 25% a lot. Yeah, that's a big move, guys. And this is going to have a major impact on the companies that we purchased months ago that are part of the website that we were in. We purchased these very same companies because I saw the setup coming. And we've got big dividends in those companies, and the dividends are going to get paid out massively with this price increase. It's going to be insane. So we're going to get bigger dividend yields, and on top of it, we're going to get price appreciation. Here's another one, Suncor. Amazing look on the weekly chart. You can see this thing breaking. I actually looked at Suncor. We can do this together. Let's do it together real quick. So here's Suncor. Let's yank it up. This is what I'm seeing in Suncor if we were to look at the charts. I see a consolidation period, this is the consolidation period all through here. That's the consolidation period. I know that looks messy. Let me clean it up. So the consolidation period is from here to here. There's your consolidation. Right now, we've broken up. We hit our head on some resistance going across, and then we've been consolidating sideways. And it looks like we're ready to break to the upside, just like Occidental Petroleum. If we were to zoom in, there's our little guy turtle heading out. We're breaking to the upside. So there's a lot of opportunities out there in oil and gas. And I'm just using Suncor because that's what was brought up. Suncor has a 5% dividend yield. 5% dividend yield, and I think that will probably go up with the price of oil. It's an oil company. So Suncor looks absolutely amazing. It does. So good work on bullish trend there. Here's natural gas. It's in a falling wedge, squeezing to a corner. It'll eventually break, guys. Be patient. Be patient. Here's some all-in sustaining cost data from gold miners. If you guys are curious. So we've got Newmont at $1,400. It's up from down from 1444. Barrick went up to 1370. Kinross up to 1360, 1390. So in Pan American Silver is up to 1,525 for the gold segment only. Equinox is a 1685. So these guys are still making money, but their all-in sustaining costs are going to go up. Now, my question is, what are their cost curves going to look like if oil goes way up? What if oil goes to $150 a barrel? What does that look like? I think the cost curve is going to continue to go up. So who makes the money in a $150 oil environment? The people who make the money are the physical owners of the gold and silver. Because whenever you buy below the cost curve, it's the least risk time to buy anything when you're below the cost curves. In silver, we are below the cost curves. In platinum group metals, we are below the cost curves at this time. So that's where the opportunity is. You have to be patient. You buy this stuff, and then you wait for that price to go up. The least risk way to do it is through physical metals. The higher risk way to play it is to buy the mining companies, and you're playing the margins in that type of situation. The margins are the difference between the all-in sustaining cost and the selling price of the commodity, and then how much they can grow production and sell. I think oil is going to be a pacing factor in the future for a lot of the margins of these companies. So I think that the cost curves are going to continue to increase, maybe even dramatically, and the money is going to flow towards energy service companies and towards energy companies, with the cost curves going up for the miners. I thought this was funny. He waited for the 172,000% run in Nvidia before buying the stock just to be safe. Yeah, that's not being safe. Here's copper seasonal chart, and I don't really know copper seasonal, but it looks like we're in season from January all the way till about July, and then we go sideways from that portion of the year onward. So it looks good, like we're in season. U.S. Big Three inventories. This is SPR, gasoline, and distillates are well below the range. So here's the 5-year average. It's below the range of the 5-year average. We've got 2024, which is you are here, and we are below that range. We're even below 2023, which is this guy right here. So we are drawing down inventories. We're very low. I think oil is going to go up with time. Joseph Brown, it says insiders getting out, retail piling in. Yeah, that's not a good thing. And this is Jamie Dimon dumping 125 million worth of JPM shares yesterday. We got Sibanye starts curtailing production. Anglo American also announced it this week. Impala and Nornickel both committed to reduce output. These are the platinum group metal miners. Now combine this with the tendencies we see in the car markets and huge short positions. Less battery electric vehicles, more hybrids, more ICE. Yeah, this is a great situation. It's a great setup. Great setup in the platinum group mining metals and the metals themselves. Sales for existing homes with at least $1 million price tag in blue continue to gain steam, up 27% year over year. And while sales for home prices on the lower end are still down, but the trend on both of them are starting to turn upward. So that looks good. Here's Tesla. It says the bears continue to defend the earnings gap. Things could get ugly here if this is basically an inverted flag pattern that could potentially break to the downside for Tesla. First Druckenmiller, now Elliott Management. What are they doing? The big boys are telling you it's time to pay attention to metals and mining assets. So it looks like they're accumulating metals and mining. And maybe this is where we are in the cycle that these metals and miners are going to rip. Monthly supply of existing homes has deteriorated of late and remained low as of January. We're really low in inventory. You cannot be in a bubble and have no inventory. That doesn't make any sense. I mean, you could be in a bubble in a certain city. You build too much inventory for a certain city, but not overall. There's people that had the same amount of money in 1980 as they had in 1970 were 80% poorer on a purchasing power basis. And that's where I'm trying to build my resiliency. I think this same environment is coming. And I'm investing in these big dividend paying commodity companies to keep my income growing faster than the inflation is destroying the currency. The typical US household needed to pay $213 more a month in January to purchase the same goods and services it did 1 year ago because of inflation. 213 more per month. Here is where this guy thinks we're at, or at least Bloomberg Finance. I don't know if he put this in there, but he thinks that we are similar in this area here. Well, this is the S&P 500. It's probably getting real close to topping out. And we've got a big inflationary CPI move ahead of us. I also think that we are very similar to this. And I think oil is going to be the one that really takes off. At least it's not the Y2K bubble. So this is the S&P 500 scaled by global liquidity. We are still off the highs when you basically divide it by global liquidity. Whoops, Pan American Silver, all-in sustaining cost comes in at a whopping $26.55. With realized silver prices at $22.33, costs are heading in the wrong direction. Management forecasts the silver all-in sustaining costs to decline by the end of 2024. We'll see. I live in interesting times, but this is also the best time to buy physical metals, is when the metal price is below a lot of these miners and the cost of the miners. And that's where I'll end it there, guys. So that's what I've got for today. Give me a thumb up for the content, subscribe to the channel, and we'll catch you guys next time. This is Finding Value.